So now I guess it's finally the West's turn, or specifically in this case, the United States, to have their turn, so to speak, of rapid currency devaluation and asset prices of all kinds just going up at different speeds and confusing people who haven't personally experienced that before. Tobacco, same thing, it is at or near a 60-year low in price when measured in gold. Coconut oil, same thing, very low, historically speaking, when measured in gold, very low in price. From the standpoint of an American and many other people around the world, it may not feel that way because wages and salaries have not kept pace with the speed of this devaluation that's occurred in the US dollar over time. They've not increased in the same proportion. So the labor that people have on offer is not tied to inflation unless they have a job that's tied to inflation in some way. They're using this type of perspective in their day-to-day lives in terms of storing purchasing power and things like jewelry, other physical commodities such as food, processed foods, to store purchasing power, certainly real estate, as opposed to keeping money in the bank. So it's another testament to the fact that deficit spending is occurring year after year, currency values decline, and it just magnifies moves, causing a person to think that the bull markets are actually much larger than they really are when measured against gold. So those things have been, I think, shocking, and I don't know if exciting is the right word to use, but certainly concerning.
Welcome to another RTD interview. Today I'm excited to have first-time guest, Mr. Tekoa Da Silva, an emerging market analyst, commentator, as well as a private investor. Tekoa has spent over 10 years as a licensed and registered financial professional, managing role as an analyst, high net worth services, as well as a portfolio manager. Today he joins us to share his thoughts on the recent market activity, the commodity cycle, as well as the role of gold in pricing commodities from a historical standpoint. So Tekoa, welcome to RTD Interviews.
Hey, Mike, pleasure to be with you. Thank you for having me on.
Yes, sir. I appreciate you taking time to join us, and as always, looking forward to getting more of your thoughts and analysis. And you've done a great job of actually sharing some PowerPoint presentation with us here that we're going to get to in a moment. But before I do that, I want to definitely make sure that the audience is able to connect with you to find out more of your work that you do. So here we have your Twitter account, or your X account, forgive me, and it's at Tekoa Da Silva. And then also you do a great job on YouTube. And so I see your recent interview with Rick Rule here. And so they can also check you out on YouTube as well for more analysis. And so I'm looking forward to getting your thoughts. And so based upon all the things happening in the world, the whole idea of rethinking the dollar, I think more people as well as nations are doing that. And so from where you're seated now as an analyst, as well as an investor yourself, and I guess what are some things that concerns you, as well as maybe one or two things that excites you as well about what you're seeing?
Great question. And I think that, the branding of your business, Rethinking the Dollar, is really prescient. And I think it really explains the things that have been on my mind in recent days, because that's something that I've had to rethink. And we'll find out about that here in just a few minutes with some of these slides that we'll go over. But I've had to rethink how I look at the measuring stick of everything that I look at, goods, services, asset prices. How can you know the real price or the real value of anything if the measuring stick or the ruler that you're using is constantly changing, in this case, shrinking in size? It can distort the way something looks. And so I know that your viewers, as well as yourself, you keep a close eye on gold. And so I've, in recent days, begun using gold quite a bit more often in terms of the measuring stick, comparing it against other things in order to get an idea of whether or not something is cheap or expensive. It's not the only metric to be used, of course. There are others, just like the idea of could a sports player be picked out of a lineup just by looking at the person's height and body weight. A lot of other metrics are required to be used in terms of assessing anything, but as one replacement in terms of using it instead of just U.S. dollars, I found it to be very useful. And then there's some other things that I find really exciting and interesting, and I know that you do as well, and you're probably the viewers do as well. And that is the shifts that are occurring. It's the BRICS nations now today, as well as the emerging and other markets as a whole. There's some really big changes going on, and the most exciting thing about it, I think, is the pricing differences between what things cost in the West, and in particular in the U.S., and then what things may cost in some of these other countries, and in particular, like their asset markets. So that's what I've been thinking about and looking at most these days.
All right. Appreciate you for sharing that. And so the measuring stick is crucial. And I think here in the Western world, especially, all we've known is the privilege of having the world reserve currency, aka the dollar or Federal Reserve note, as I also like to, make sure I distinguish. And so now that things are changing, I think it's also a great time for people to begin measuring and reassessing, I guess, their entire financial outlook and different metrics. And so we're going to definitely dive into gold. And so the whole idea of gold over the last centuries has always been a constant anchor and a store of value and a measurement tool in of itself. And so with the fiat, I guess, decoupling now, gold has reached all-time highs in all currencies. And so I remember throughout the last couple of years focusing on how gold was performing well in other currencies based upon the activity within their nations and all the debt deficits and stuff that other nations are experiencing. So here we are in the U.S. and it's happening to us now. So real quick, I guess, based upon the recent all-time high of gold, what is that a signal of in your estimates? Like, what are some things that it has exposed that the people should definitely pay attention to if they haven't already?
Something's happening with the currency, and it's happening pretty quickly. It's happening at a faster speed. I'm a fairly young guy still. Both are. I'm fairly young, but during my lifetime, as sure as it has been, the speed of the inflation now, the price inflation that I'm seeing around, and the asset price inflation, in the U.S. It's happening at a faster speed than I've ever seen before, and I'm just speaking specifically in reference to the mid 2020 period up until today, which is about mid 2024. Maybe this is on the low side, but my estimate is that my personal cost of living and a lot of the things that I look at on average, like let's say 100 different goods, products, services, commodity prices, I think the average is these things are up by about 50% from 2020 to 2024. And so I just did some napkin math, and that translates in my mind into something like a sort of a stealthy 35% devaluation in the dollar without it being formally announced, without anybody being given forewarning. And I'm reminded of looking at some of these foreign markets, other countries, places like Africa. A recent example that I looked at was Kazakhstan. When you're looking at stocks in some of these other countries, the price speed over a 5 or 8 year period may have gone sideways or up 50%, or it may have doubled. But when looking at it, the person always thinks to themselves, well, wait a second, what has the currency done during that same time frame? Because sometimes the currency relative to the dollar or relative to the gold priced in that foreign currency may have gone up 4 or 5 or 6 times. But if the price of a particular stock, or let's say a piece of real estate as an example, only went up 50% or only doubled, it actually means it's declining in price in real terms when you measure it against gold. And so now I guess it's finally the West's turn, or specifically in this case, the United States, to have that turn, to have their turn, so to speak, of rapid currency devaluation and asset prices of all kinds just going up at different speeds and kind of confusing people who haven't personally experienced that before.
Right. Now, if the measuring stick or the barometer for the determining factor for the value of an item in and of itself is transitioning out of USD terms, internationally speaking, at some point, and gold comes back into the equation, whether done by the BRICS or any other the unions that are forming out there, I guess I try to wrap my mind around the concept of like how do we then begin placing value on things? Do we use the metric, or do we use ounces or an ounce as a measuring barometer, on a broader landscape, or perhaps grams? And I'm also referring to how I think it was in 2022 when the whole Russia-Ukraine conflict kicked off and the Russian central bank opened up, I guess, the acquisition of gold and somehow linking it to a barrel of oil. So 1 gram was 1 barrel. So we talked about that for forever. But in your estimates, how could people begin measuring value in ounces, grams, or what are just some hypothetical ways that people can look at this?
Well, I guess it's up to each person to decide for themselves. If you used a full gold ounce as opposed to a single gram, the numbers might be skewed a little bit. If you, like, let's say, as an example, took the price of a 5-pound bag of flour, let's say organic flour, because the price for that has probably gone up more than non-organic over time, and you put together the prices over, let's say, a 20-year period, and you plotted it on a chart. If you used an ounce of gold or if you used a gram of gold, the characteristic of the chart would probably look identical. But the numbers, the ratio numbers would look different. As an example, if the 5-pound bag of flour costs about $6.50 US, and you divided that into, let's say, the gold price of about 23.51 an ounce, your fractional numbers are going to be sort of they might look a little bit confusing. Whereas if you took the a full gold ounce at 23.51, divided it into grams, I believe it's 31.1 per troy ounce, and then use that as your figure to compare, let's say, the price of flour or the price of a car wash or something like that, just to make a random example. Your numbers would just from a fractional standpoint would appear much smaller. So it might be a little bit more digestible, like for your eyes or easy on your eyes in terms of looking at.
Right. Great analysis there. Great assessment there. And so, moving forward, gold is back into the equation clearly. And so, I remember doing some interviews in the past where a lot of mining experts as well as exploration companies were hinting at commodity super cycle, and they were saying any minute when gold is going to break and it's going to really reveal the to the world what's real and what's not. And so, I guess at this current moment with gold and all-time highs, price in fiats, we're officially in a commodity cycle or a gold cycle with the commodities referring to other metals and assets soon to follow, or what are you thinking?
Gosh, what a good question, and it's tough to say. How do you define a super cycle? I know there's a technical definition for it that's available on Google. But one way to achieve, I guess, a quote unquote super cycle could be a single round or a multiple round devaluation of currencies, possibly led by the U.S. dollar. And that could produce enormous moves, nominally speaking, in many commodities, precious metals included, that could appear to most people as what they would describe as a super cycle. But would that actually translate into more consumption of various commodities and more actual economic activity in terms of construction and building and trade and so forth? That it might not necessarily translate into that, but certainly nominally speaking, it could turn into some serious fireworks for sure.
All right. Now, I'm curious now. I'm ready to dive into the presentation. So, for those who are tuned in, part of what excites me to have you on is the work that you've done and the work you've presented for us, where this is my first type of masterclass type of, I guess, discussion where you're going to walk us through some things that really paints a very unique case that I haven't seen on the internet as of yet. So, thank you for putting it together for us. And so, as I transition over, I'll let you get behind the driving wheel and kind of lead us into your investigative work and this deep dive here that you have for us. So I guess have at it.
Sure. Thanks, Mike. So I'm not holding myself out to be an expert or claiming to be an expert or knowing anything more than anybody else. I just reached a point where I thought, as we discussed with regard to not having a reliable ruler to measure things against, I wanted something reliable, durable to measure asset prices and commodity prices specifically against, just to get a firm view of what I was seeing around me in terms of these increasing commodity prices. So I put together this information really just for myself. And so I've got the slides here, and we'll get into them now. But I should point out the second item here is just an important disclaimer that this information is just for educational, informational purposes. Nobody should make an investment decision based on this information. You should always consult with a qualified financial advisor before making any financial decisions. But so the first slide here is just the very interesting chart that your viewers are already familiar with, likely, which is just the gold price, priced in U.S. dollars from about 1960 to today, in 2024, or until May 2024. This shows the price of gold moving up from $35.27 an ounce, based on World Bank figures, to today's price of $2,351 an ounce, roughly. This is dated as of an earlier day in May. But this translates into a 67-fold move for the price of gold, or 6,700% increase. So any asset price, like let's just say a commodity, that doesn't keep pace with the price of gold, technically speaking, becomes cheaper over time, or any commodity that outpaces the price of gold in terms of its U.S. dollar price increase, it could be said as becoming more expensive relative to gold over time. And so this gold chart, of course, it's interesting. But what I did for my own entertainment purposes is I flipped the chart over and I priced U.S. dollars priced in gold. And when you flip it over, I just found it to be very interesting. It reminds me of those silver content charts of the Roman denarius. As the silver content of their coinage plunged over time, the purchasing power plunged as well. And while their charts were, charted over like a 200-year period, this still is from about 1960 to 2024. But it basically shows that from around 1960, you could buy a single full ounce of gold for $35.27. And today, roughly, you could buy 0.015 an ounce of gold for that same $35.27. So roughly speaking, that implies a loss of purchasing power of US dollars priced in gold, a loss of purchasing power of about 98.5%. And each of those major plunges down that you see on this chart is basically the what was the nominal all-time high price for those three periods, which was in 1980, about $850 an ounce. 2011 was about 1920 an ounce. In 2024, so far, I believe it's 2,449 an ounce that we've seen as the price. So this just basically showing how the dollar, the purchasing power, is just becoming smaller and smaller over time. And so what I found to be very interesting was plotting with these World Bank figures the prices of various commodities against gold, pricing them in gold, in other words. And it's just using a gold ounce as opposed to a gold gram. And I went down this big list, and I'll just flip through these very quickly, Mike, and please stop me at any time. But the first one here is Australian coal. And when I look at this 60-year price chart, this is priced in gold. It doesn't look like it's at the upper right-hand corner of the chart, like a lot of other asset price, US dollar denominated asset price charts are showing. This is in the bottom right-hand corner. It's near its bottom trend that it's displayed over the last, about 30 years. And so what I did for a number of these charts was I took their peak, the peak pricing that was demonstrated compared to gold over the last 60 years. Mm-hmm. And in this case, the peak was in 1981. It was a ratio of 1.448, a metric ton of Australian coal compared to an ounce of gold. And this chart tells me that priced in gold, Australian coal, along with many other commodities, as these other charts will show, is pretty cheap. And it would have to move up about 23-fold in order to reach that same peak that was demonstrated in 1981. So going through this list, Brent crude, it's also not anywhere near its all-time high over the last 60 years, as demonstrated against gold, which was in 2008. It's toward the lower end of its range. Uranium, same thing, priced in gold. It is nowhere near its 2007 peak. If we go to this next chart, the price of uranium, on the right-hand side of the chart, this is just denominated in US dollars at $136.22 a pound. That was the nominal price shown in 2007, but right now it's priced at about $91.75 a pound. It looks a bit more dramatic than if we flip back one page and we price it in gold. It looks sort of subtle, this recent move that we've seen. And if you were to price it again using a peak price as demonstrated against gold in 2007, it would require a move greater than fivefold from here, priced in gold, in order for it to reach or exceed that prior peak in 2007. And uranium, as our uranium buffs or history students watching this will know, demonstrated higher peak pricing in earlier years measured against gold. But going right down this list, natural gas, same thing. It is very cheap, historically speaking, relative to gold. It would take an enormous move priced in gold for it to revisit its the year 2000 peak. Platinum, same thing. Our platinum viewers, our students of platinum will, and probably yourself too, Mike, I think, will recall that priced against gold, the platinum is at something near a 100-year extreme. It doesn't mean that it has to be reversed, but it's very interesting to look at in gold terms. Silver, it is in the lower portion of its trading range as well, and our precious metal students will certainly be familiar with the silver to gold ratio history as well. Zinc, bottom range of its history priced in gold. Same thing with lead. Same thing with tin. Despite the recent move in tin, it's at the bottom of that range. Same thing with nickel. Copper as well, despite copper's recent move. The ratio peak that demonstrated in 1966 was far higher, about 54.29 as a ratio against an ounce of gold. That would require from here to revisit or exceed that 1966 peak as measured in gold, it would require a move in copper of greater than 12 times. Will that happen? I've got no clue. I'm not calling for that or suggesting that it will happen. It's just an observation. Aluminum, same thing as the other base metals. The industrial commodities are quite low, measured in gold. Iron ore, same thing. Potash is at the bottom of its range as well. Corn, along with the other agricultural commodities, are very cheap when measured in gold, looked at a historical basis over the last 60 years. Same thing with soybeans, wheat, cotton, oats, rapeseed oil, cocoa as well, despite cocoa's recent move that has garnered the attention of the corporate mainstream press. They've been circulating articles about cocoa being in a bull market, but when we look at it priced in gold, the recent move, as seen in this nominal chart of cocoa priced in nominal US dollars, this recent move looks really impressive. It looks to be far larger than the move that was shown in 1977. I believe the prior peak at about $4.25 a kilogram. But once again, when we flip back and we look at it from the perspective of gold, it is the recent move, a tiny blip on the right-hand side of the chart when measured against gold. It would need to probably move up more than about ninefold from here to reach or exceed its 1977 peak as measured in gold. So it's very interesting to think about how the currency devaluation, or the loss of the purchasing power of the currency, is really distorting the way things look and how things are described, certainly by the popular mainstream press. Coffee, same thing. Bottom of its range. It looks very cheap, very available price-wise when it priced in gold. Tea, pulling pricing from 3 auctions in Colombo, Kolkata, and Mombasa, shows just a wonderfully cheap and abundant tea market in terms of its price when priced in gold. Thai rice, same thing, absolutely cheap, abundant commodity. When priced in gold here, it's just probably near its cheapest point that it's been in 60 years. Sugar, same thing. Bananas, same thing. Oranges have had a recent nominal US dollar increase in price, as shown on another chart, which I didn't include in this presentation. But the recent move in the bottom right-hand corner of this slide shows sort of a mild move when priced in gold. The prices of oranges, in terms of a kilogram priced against gold, to reach or exceed its 1970 peak when measured against gold, would need to move up more than eightfold from here. Not saying that it will, or that it could, or that it should, but it's just an observation. Beef, same thing, at the bottom of its 60-year trend. Pork, same characteristic here in the chart when measured against gold. Chicken, same thing, very cheap, very available, historically speaking, when looked at the price of gold. Milk, same thing as well. It is near or at a record low as far as this data that I was able to pull from the USDA and the World Bank. Palm oil, a commodity produced in Southeast Asia, wonderful commodity used for food and lots of other things. Wonderfully cheap as well when priced in gold. Tobacco, same thing. It is at or near a 60-year low in price when measured in gold. Coconut oil, same thing, very low, historically speaking, when measured in gold, very low in price. Rubber, near historic lows as well, when priced in gold. Malaysian logs, at or near a 60-year record low when priced in gold, measuring a cubic meter. When looking back at the 1993 peak, when measured against gold, would require, if Malaysian logs were to revisit or exceed that peak, would require a move over 17-fold from here in order to revisit that peak. So, as those charts described, Mike, commodity prices, when compared against gold, are historically still very cheap. From the standpoint of an American and many other people around the world, it may not feel that way because wages and salaries have not kept pace with the speed of this devaluation that's occurred in the US dollar over time. They've not increased in the same proportion. So the labor that people have on offer is not tied to inflation unless they have a job that has sort of a that's tied to inflation in some way. That would allow them to have a rising income as the price of or as the price of gold or as income increases over time. A lot of people in the financial services industry do have that, when they're able to collect management fees based on the portfolios that they manage. But unfortunately, not enough industries are able to tie their wages and income to inflation. So that in that way, it feels as though these things are becoming much more expensive. And when you price them in gold, they're actually quite cheap, historically speaking.
Okay, so looking forward to getting back into the presentation there. So just as you went from slide to slide to slide, real world assets, real world commodities, real world necessities, things that we need for consumption's sake or to build out the lives that we have. When priced in gold is at all time 60-year lows, but then measured in fiat terms, whether it's the dollar, the euro, any of those currencies, average person who is not aware of the difference and the distinctions of how you measure, whatever measuring stick you're using, will get a different outlook. And so also pricing your current financial expenditures as well as your future expectations of preserving and protecting your wealth, if done in fiat terms, based upon what you just shared with us, you can be led astray. You can be led down you can be given a false narrative and a false reality that is not real. If and say when gold is brought back into the fold as far as a international measuring stick, similar to what it appears that other nations are trying to do, to hit it on earlier. So, wow, just so once again, it's not financial advice that's being given. I like to consider it more so, monetary uncommon sense, or you see what I'm saying? Like, if people knew monetary literacy, monetary history, they could see the distinctions here that you're referring to here, which could be crucial for your financial futures. And that's a long-winded answer. What I'm trying to get to is like, this information is very important. So, yeah. But it doesn't stop there. It doesn't stop there. Feel free to have back at it.
Yeah, and just to add to that, our friends that live in other countries like Lebanon, West Asia, Turkey, countries in Africa, as an example, in South America, many other places that are used to living in times of rapid inflation in their currency. This is they're using this type of perspective in their day-to-day lives in terms of storing purchasing power and things like jewelry, other physical commodities such as food, processed foods, to store purchasing power. Certainly, real estate, as opposed to keeping money in the bank to protect purchasing power. So, I think Westerners and in particular Americans, I think these are skills that they'll probably benefit by adding into their perspective of the world. I guess, and I think inflation is probably going to be with us for quite some time. Probably, I guess it could get much worse. So they might benefit by incorporating this thinking into how they see the world.
Right. Very true there. Yeah, man. This is, yeah. Okay. Have at it.
Yeah. And so just to add on to this topic of commodity prices and increasing of nominal pricing of commodities, the corporate mainstream press, always in the West, they always explain why things happen. They describe things occurring as having there being a catalyst, and in some cases it may just be the expansion of debt, expansion of the money supply, devaluation of the currency that actually causes it to occur. But the press likes to have catalytic reasons for explaining things. And so I thought it might be helpful. And we've seen some of these in recent times, and they are real catalysts. So I thought to put together just a little quick list here for our viewers to take a look at. They'll recognize some of these things. What can cause a commodity price spike, both in nominal terms as well as in real terms when we measure it against gold? In really simple terms, I've read a decent amount on this topic, but it's shortages for any particular reason. And there can be a whole bunch of things that can impact the supply as well as the demand. But certainly the supply destruction can be a very powerful force. And so to start with, you can have a currency devaluation, expansion of the money supply, and increased debt. That can create the conditions or the kindling, if you will, for to put what is nominal pricing power into people's hands for them to throw at any asset that they decide to. But then other events that can actually serve as a trigger for a shortage or of an interruption of supply can be like a weather event, a storm. There could be flooding and excess rains, or there could be a drought. There can be kinetic events like we've seen in recent times, explosions, fires, mine collapses. There can be social political events like war, political actions, sabotage, by competing parties, possibly state-led. And we've seen recent times of explosions and possibly political action in regards to the Nord Stream pipeline, which had a huge impact on energy pricing in Europe over the last couple of years. And then the distribution system events, shipping lanes, whether it's on land or the global ocean, the sea lanes of communication. It could be the ports, it could be the storage facilities that hold the commodities. We've seen interesting port and storage events occur in recent years, and one that comes to mind certainly is the port explosion that occurred in Lebanon a number of years back. And then, of course, there are always the financial market events that can occur, such as short squeezes, where producers or other participants in the market may be short a commodity, and then an unexpected event like one of the above occurs, and then they would be forced to cover, causing an absolute vertical price spike to occur. And I think that's happened with many of those commodities that we've looked at in this slide deck so far in the years past. And then, of course, a combination of some, or God forbid, all of the above in different places at different times to different commodities. So these events can result in a supply shortage, which can be compounded. The problem can be compounded by export restrictions and price controls. When the government gets involved, they usually make matters worse, as many historical examples can attest to. And some of the things that they do are, as you and the viewers know, is export restrictions. A country may decide to keep price inflation, denominated in their currency low within their country. They may say, we're going to halt exports of wheat or rice or another commodity just to keep inflation low within that society, to prevent social and political chaos from breaking out. And so that export restriction, if it's a major producer, it can cause a ripple effect and problems to occur, supply shortages to occur in other countries that rely on them for their exports. And then, of course, price controls, when governments come out and say, you're not allowed to sell a commodity or a good for higher than this price. And if that price is, as it usually is, below the cost of production, all of a sudden production disappears. Farmers run away. They decide not to grow any of a certain crop if they can't, cover their costs and make a reasonable profit. And then, so the climax of these types of events occur with panic buying and short squeezes. They don't happen all the time, but they do happen with regular enough frequency that they're considered pretty regular events throughout history. And then some recent disruptive events that we've seen is the Russia-Ukraine war, which, if anybody's looking at news, which we can talk about, it looks as though it is way not over. It may still be in an early phase. Who knows how and where this conflict will develop. But that was a major disruptive event because Russia and Ukraine, as the viewers know, are major grain and agricultural product exporters. And a lot of those very important crops exit through the Black Sea and through the ports in the Black Sea. And so that is is a major disruptive event. The Suez Canal blockage that occurred in recent years, another disruptive event, as well as the Panama Canal, the slowing down of transmission through that canal due to drought rain conditions, and the water locks that they use have decreased traffic through that pathway. And then, of course, as we just very quickly mentioned here, the Nord Stream gas pipeline attack. That was just a major disruptive event. And then also we have, in my living memory, and I'm still a fairly young guy, so it doesn't mean much when a young guy says it, but in my memory, the potentially enormous disruptive events that are out there, again, potential, seem really numerous, and they seem to be growing with sort of depth and in number as the weeks and months pass. And so a couple of them, just to quickly name them, are the Israel and Palestine war that's engulfing, potentially engulfing West Asia. It could potentially drag in Iran, which I guess we saw some early sort of glimmer of that happening. And then that could potentially imperil the Hormuz Strait choke point. This is a super important waterway for daily oil energy supply transmission. If that Hormuz Strait choke point is ever congested or blocked, it would cause some really awful things to happen in the global energy markets. The Hormuz Strait, further down here in this slide, the estimate there is that it's about 20% of daily global LNG supplies, and about 21% of daily oil consumption transits that. that strait. And so that is a major, let's call it a strategic asset, if we could put it that way, of Iran, of their literal shores, to be able to have control over that waterway. The U.S. China conflict escalation. Uh, it's been happening now for years as currency, of course, trade war, but now the rhetoric is ratcheting up. And there's, it looks like very early stages of military action occurring on both sides, as you know, or possibly preparations for potential conflict. And of course, on the U.S. side, they point to Taiwan, as well as a number of other issues in regards to one of their driving forces for their activities. But a very, very fascinating place that is probably not thought about or talked about enough is, of course, the South China Sea in Southeast Asia in general, the waterways there, but specifically the Malacca Strait choke point. It's estimated, this is a bit dated, but it's estimated that about half the world's shipping, daily shipping, traverses that strait. And if there were to ever be a sort of major kinetic conflict there, if that Malacca Strait was blocked, shipping would have to reroute around it and possibly through the. There's another strait another transit pathway that can go through Indonesia, but it would put a severe disruption. It would present a severe disruption to shipping of all kinds of consumer goods, commodities that the world relies on a daily basis. And then, of course, going back to the Russia conflict, what if this Russia-Ukraine war expands into a Russia-NATO broader conflict, pulling in, God forbid, other countries within Europe? And if that happens, awful things could occur with commodity markets. But of course, it could cause a domino effect or a chain of other events to occur, possibly involving the Black Sea. It's a very sensitive place. And so there's this set of straits that we'll refer to here as the Turkish Straits. And these straits are the transit point for, the majority of Russian and certainly Ukrainian in Kazakhstan produced grain and energy exports. A lot of the commodities go through there. So if there were to ever be an issue, that could cause major, major problems, on the supply side. And then, lastly, I have a little slide here of some ideas. These are not recommendations at all, but these are some. If somebody thought to themselves, how can I research this in terms of companies that are participating in this, commodity marketplace as a starting point for educational research? There are a series of major Western commodity producers that they could look at that are in the commodity business. They produce and sell commodities. I should point out too, which we can talk about in just a minute if you like, Mike, is that a lot of these Western listed, headquartered commodity producing companies, when you look at from the standpoint of, let's just use simple valuation metrics such as price to book and PE ratio, throw in dividend yield as sort of simpleton metrics. For commodity producers, there are a lot of other metrics very important to use. But if we look at them at the surface, the Western producers using common metrics can appear to be more expensive relative to their emerging market peers, and certainly particular countries within the emerging marketplace. But just a quick list for educational research if somebody wanted to. Industrial base metals, they could look at BHP, Rio Tinto, Glencore. Fertilizers, they could look into SQM, Mosaic, Nutrien. For farmland, water, cotton, tomato producer, JG Boswell. Again, not recommendations at all. Energy, of course, the very well-known names, Exxon and Chevron, people can look into. Just an interesting observation there that, that collection probably generates around about a 5% dividend yield when looked at as a group, maybe a bit less than that. But like I said, the emerging market commodity producers are a bit cheaper, but that might require more work on behalf of the person who is considering looking into that area. And then it also presents a different question in terms of political risk, not just in terms of where they're operating, where the assets are owned, but also probably the nationality of the person that decides to look into them. Because as we've seen in recent years, a person's nationality and to whom the government that they report presents a different risk, a different type of risk nowadays as well. And if you'd like, Mike, I could just keep going right here and just talk about some basic
Yeah,
observations.
if you don't mind, if you don't mind, yeah.
Okay. Yeah. So, gosh, this started for me, Mike, around 2018 or so. And I started looking at countries that were in Africa, as well as Southeast Asia and China. And I started noticing at that time, and it's still the case today, a lot of the companies that are the African continent, boy, when you use a sort of gram and dod, value investing metrics, again, very sort of overly simplified metrics. But maybe a decent place to start with in terms of just information and education. A lot of companies in these regions are statistically, they show themselves to be very cheap when looked at from that perspective. And so starting around 2018, I started looking at lots of these companies, and I noticed that they were all demonstrating a similar chart formation. When I looked at, let's say, price to book measured over like a 15 or 20-year period, price to book, I guess, oversimplified way I could describe it as being like a replacement cost to, let's say, buy all the assets and replace the entire business or what they spent, roughly speaking, building the business. And then you compare that to the price that it sells for in the marketplace. Kind of like saying, how much did it cost to build this single family house? And then what is it priced at in the market? And if the cost to build it was 100 grand, and the cost to build it today would be 150, but it sells for that single family house for 50,000, you know that it's selling for half the cost of production and probably a third of the potential value in the marketplace. So that's what possibly equivalent for price to book could be looked at. But what I saw looking at China at the time, Russia, and a lot of African countries and other emerging market countries as well, is they were all just sort of in a bear market. They've all been in a 15-year, now it's become about a 17, 18-year bear market since around 2007, which was the peak of the last BRICS bull market. And at the time, it was celebrated, of course, as being sort of probably a cute sales pitch to sell from the corporate mainstream standpoint to get the general public to buy overpriced BRICS securities, BRICS stocks at the time. They were expensive at that time, but they've been in a 17-year bear market, most of them. While the earning power and the in many cases, the size and dominance of the business, the value of the businesses have grown, but they've declined in price ever since or have gone sideways. And inflation has caught up, as we've discussed, nominal inflation, which has changed the valuation picture. But on this slide right here, just a couple quick stat quotations pulled from worldperatio.com. It doesn't. I'm not saying that these are precisely accurate. I'm just assessing these as estimates, and these are estimates of ETFs. And ETFs that are listed in the Western marketplace usually contain the more expensive companies of a particular marketplace. So they might be a little bit more expensive than the local equities of that particular market anyway. But just looking at PE ratios, again, it's not the only ratio, but just one of them to consider. Colombia, 5.75. Brazil, 7.45. Turkey, 7.6. Malaysia, 8.3. China, 9.31. South Africa, 10.75. Indonesia, 11.36. And then there's a very sort of probably well known and it's sizable ETF called the iShares Emerging Market Dividend ETF. This the basket of companies in that ETF, and it contains actually a lot of the individual companies that I've pursued laboriously in terms of trying to analyze value on. They're in that basket. I don't recommend anybody buy this. So I'm not giving any recommendations or financial advice here, but just as an observation, the stated statistics from their website show the price to book ratio. They're just a bit over 1, a PE ratio of a bit over 7, dividend yield over 8. And just as another quick observation, many of the individual companies that I've looked at that have been in these foreign markets, in particular these days, the Chinese companies listed in Hong Kong, the Colombian companies, and some of the Brazilian companies too, it can be priced at PE ratios under 5, some as low as 3 or 4. Price to books that are 20, 30, 40 cents on the dollar, and dividend yields that are over 8%, in some cases as high as 10, 11, or 12%. But everybody has different opinions. Some people think that the Chinese companies are just fake and are misrepresenting all their figures, and that's fine for somebody to have that viewpoint. I'm not going to try to convince them otherwise. So these, just using the PE ratio as a simple metric, when you compare it against the U.S. market, on a PE basis, the U.S. markets are near the most expensive point in history. This chart published or pulled from Robert Schiller's work is the 10-year average PE ratio. It's being shown at a bit over 30. But I've seen many estimates, usually, or many different, yes, many estimates of different American equity averages showing PE ratios of usually being over 20. And price to books are usually quite large. Just on the low side, I'll say probably 5 times and or much higher, depending on which particular index you're looking at. And so if we look at the U.S. Markets compared to world markets, and certainly emerging markets, this is a chart pulled from Yardeni research, the U.S. markets are showing themselves, statistically speaking, as the most expensive equity market globally, just in this one metric of price earnings ratio. Emerging markets as a basket, and the emerging markets basket, most of the emerging market baskets include the other countries that are more expensive statistically speaking, such as India, and a lot of them include they refer to Taiwan in their baskets, although China refers to Taiwan as being a province of China. So just going back to our earlier discussion of how do you know the price of anything if the measuring stick, the ruler that you're using, is constantly changing or declining in purchasing power in the case of the US dollar. So just as a very just quick little snapshot, I pulled a chart here, just going back to about 1996. This is the S&P 500 ETF, SPY, measured against gold. And it has not reached or exceeded its 1999 peak. So measured in gold, the S&P 500 is at a lower price than it was at the end of 2021 and at a lower price than it was in 1999, despite nominally speaking it being far, far higher. So maybe that can attest to the fact of this deficit spending and decline in value of the US dollar currency, or money illusion that's causing these nominal price quotations just to soar. But when priced in gold, the picture looks quite different. And since I mentioned the whole topic of emerging markets as a whole, the next chart is just an ETF. It's the EEM, Emerging Markets ETF. There are other charts that are a bit more extreme on the downside, but this is just a visual illustration that the Emerging Markets ETF is down 63.8% from its 2007 high. Again, that's going back one slide, compared to the S&P 500 being down 34.3%. This ETF, when measured in gold, again, the emerging markets here is down 63%. So it priced in gold is at a price point that's not too far away from its 2009 and 2011, as well as 1998 price points. So it doesn't mean that using this chart alone, one can say that anything is cheap, but it's just one extra metric that a person could add to their arsenal of many measurement tools to just get a sense of what the world looks like from a different perspective. And then otherwise, I have some other slides that we can talk about that are a little bit more geopolitical in orientation, if you'd like.
Yeah, no. So just to kind of condense everything you've shared down, last couple of slides in particular, when you're measuring things in fiat terms, it just goes to show a different outlook and as well as possible outcome given the future we're heading into, as opposed to measured in gold. So definitely that just gives the viewers another way of measuring things and just getting a chance to reassess how they, I guess, are rethinking their allocation as well as their portfolio strategies moving forward. And so I guess when you were putting all this together, because you live in this world for the most part, analyzing things of this nature, out of all the graphs that you put together thus far, I guess was anything that you came across like mind blowing or shocking, even for you being a trained eye? Anything that stood out or really caught you by surprise, perhaps, or no?
Yeah, a couple things.
Yeah.
The first is on the commodities. If the West and if the U.S. is positioning itself, and it looks like it may be, for a return to wartime, war is probably the most powerful supply disruption event that can occur with commodity supply. It's I hope it doesn't happen. It's wholesale destruction of human resources, people, and natural resources, commodities. It's just one day after another of destroying and blowing up meticulously prepared and produced and manufactured and harvested commodities. And either side can sabotage or attempt to disrupt the production and supply chain, supply availability of the opposing parties' commodity supply sources, their supply chain, because without the logistics, and I'm not a military expert, I'm not trying to pretend to be one, but I'm just following commentary from people like Colonel Douglas McGregor and many others who are specialists in that field. The impression that they've given me is that the logistics chain, the support logistics chain for any warfare activity, is as important, if not more important, than the actual, as important as the warfare activity itself. And the logistics chain is very intensive toward the idea of commodity supply management. Um, and so, in recent times, I noticed just in over the last 6 months or so, and maybe it's been a bit longer than that, the corporate mainstream news media press, sources such as CNBC, I'll even put in Zero Hedge and others, they've been sort of drumming up excitement about commodity price increases, such as cocoa and copper, and almost celebrating it. And I think it's unfortunate because the U.S. dollar denominated increase of those commodities, one, it's a testament to the fact that the value of the money, of the currency, is declining rapidly. So if the dollar was still convertible into gold or tied to gold somehow to give it a firm stability in its value, some portion of the commodity price increases would not be occurring. There would be no bull market to celebrate, and there are no capital gains to tax, of course, afterward by the participants. So that was a shocking thing to me to think about. And the other shocking thing is during wartime, the government spending it can dwarf periods of peacetime. And if a government needs a supply of a commodity to fit its logistics chain, let's say grains, to feed people, to feed its soldiers, to feed its civilian population, they'll print any amount of money, or they'll take any action that they deem necessary from the standpoint of national security to obtain and secure supplies of that commodity, irrespective of price. And so these moves of double, triple, or fivefold, even roughly for cocoa, while they've been really amazing to watch, what could happen? If God forbid, I hope it doesn't. The optimist viewpoint is that the conflicts don't get worse, and that we go right back to peacetime. That's the ideal outcome. But what if things like Nord Stream, what happened to the pipeline, and the agricultural product shorted the period of interruption, with the Black Sea ports, if things like that were to continue, it could. So thinking about that has been one of the most shocking things to me, Mike. And then the other thing is, and then the aspect of it goes hand in hand, is how does a person defend themselves? How do you protect yourself against that? How do you prepare? How do you shield yourself, your family, and your friends? I mean, what a fascinating topic to think about. And so it involves finance, it involves investing. If a person wanted to do that, not recommendation, of course. And then the other thing too is just looking at the price moves of some of these emerging market securities that I enjoy as a fun hobby for me to analyze. Nominally speaking, the price moves of some of these extreme lows in nominal terms, in US dollars, and certainly within their currency, can be enormous, off of major long-term bottoms, moves such as 10, 20, 25-fold in price. But in some of these historical instances, I went back and I priced those same moves in gold, and the moves were much smaller when measured in gold. So it's another testament to the fact that money is being printed year after year, or pardon me, deficit spending is occurring year after year, currency values decline, and it just magnifies moves, causing a person to think that the bull markets are actually much larger than they really are when measured against gold. So those things have been sort of, I think, shocking, and I don't know if exciting is the right word to use, but certainly concerning.
Wow. 3 or 4 angles there that you presented to us that really should get anybody to think, because we're all in the same boat. Ultimately speaking, the remainder of this decade here, we're going to probably witness some things that we couldn't have ever imagined, whether it be geopolitical events, we have the presidential season coming up and all the things to do with that we didn't really dive into, but that definitely plays a major role in how things are how our financial affairs are conducted in this country. And then the practical sound investment strategies now need to be restructured, just because the 60-40 model that has been preached forever no longer carries the same value. And so that's something I'm sure you have some thoughts on as well. But we're approaching an hour, and I know you still have some slides to share with us, but I figure we'll give a tease or a sample or a taste to the viewers to digest this, because definitely you have to go back and rewatch this and really understand the magnitude of what you shared with us. But hopefully I'll have you back on in the future and dive even deeper, because of course, I nerd out over things like these as well, just because, I mean, how could you not be concerned with things being done around you that impacts your life? And when you see the manipulation of assets in different categories occur because of the currency, it just really should make people rethink some things. So let me just share with the people once again where they can find you at. Here you are on x.com. Go take a look and subscribe, as well as on YouTube. That'd be a great way to, I guess, follow you or whatnot. Any other places you want to point them, or give, I guess, the viewers a sample as to what they can expect when they connect with you?
Well, yeah, they can reach out to me on those social media channels. I don't really have anything for sale, but they can, friend me on there or send me a message or something like that. Be happy to, befriend anybody.
And so for those who are plugged in and enjoyed the demonstration here, I'll actually put the link down to the PDF format so they can grab a hold of all those charts you put together so they can plug in. So once again, thanks for putting that together. And of course, thanks for joining us on RTD Interviews.
Hey, Mike, it was a pleasure to be with you. And I have to, quickly just mention that, Rethinking the Dollar is on my daily read list. So for anybody watching, make sure to subscribe to Mike's channels. He puts out just spectacular work, and sign up for his email list. I think as you mentioned, the slides are going to be available underneath this video. But hey, thank you very much for having me on. It was very nice to speak with you.